Welcome back to another episode of Palisade Radio. I'm your host, Karem Mamutlu. And on today's show, we welcome back the president and CEO of Sprott US Holdings, Rick Rule. How are you, Rick?
Karem, life is wonderful at Sprott right now. Thank you.
Very good. And let me start by saying congratulations on the Sprott Natural Resource Symposium. I heard it was a great success.
Thank you so much. We were very pleased with this year's show. Some of our new speakers, Daniela DiMartino, Nomi Prinz, it was a great show this year. And, in fact, the market helped. There were a couple years where we were saying, precious metals are going to come right. This year, we were able to say, well, precious metals are, in fact, coming right. So it was a wonderful conference. Everybody worked very hard. Thank you very much.
Let's begin by talking about when you first started out, Rick, and let's talk about the bull market in gold and silver back in the 1970s. You have stated in the past that you confused the bull market for brains and essentially stayed too long at the party before leaving it with a negative net worth. So has that pivotal moment in your career stayed with you in terms of understanding where we are within a bull market? And how did you essentially begin again by speculating within the markets? Most people would have given up and done something else. So why did you stick with it?
Well, that was certainly the deepest of all lessons. A few things happened. The first is that rising prices always, particularly for the uninitiated, justify the narrative. And the narrative in the 1970s was, of course, the sort of Malthusian Club of Rome narrative that we were running out of all things materials-based. And rising price levels that we saw, not just for gold and silver, but for oil and soft commodities and copper and everything else, justified that narrative. What happens in a circumstance like that is that many people, myself included, forget that markets work. When prices go up, two things happen. People learn to conserve. They learn to use materials more efficiently. They learn not to waste at the same time that those high prices encourage supplies of the materials that had been going up in price. And I, like the rest of the market, forgot in the 1970s that eventually markets would work. The bull market of the 1970s gave way to an ugly, ugly, ugly bear market in the 1980s. My other problem, of course, was that I, like many young men, confused a bull market with brains. The fact that I made a lot of money in the 70s, when many of my young competitors in more general financial services were losing money in an epic equities bear market, caused me to believe for some strange reason that I was smarter than them. When in fact I merely had the wind in my sails. When the market turned rather dramatically in 1982, I learned just exactly how smart I was, which is to say, not very. But I learned a lovely lesson. In capital-intensive cyclical businesses like natural resources, you are either a contrarian or you will be a victim. And bull markets are the authors of bear markets, and bear markets are the authors of bull markets. Sure enough, the bull market of the 1970s gave way to the bear market of the 1980s. I was able to redeploy and position myself so that in a mini bull market in the middle of the 1980s, I got myself back to even. And in the short term but epic bull market in the early 1990s, I made what is even today a reasonable fortune. So it was the lesson that bull markets are the authors of bear markets and bear markets are the authors of bull markets that I took away from that. I would encourage your readers, in fact, if they contact me at the email address which you can provide, I will furnish your listeners a 40-year Barron's Gold Mining Stock Index chart that will point out both the volatility in these markets and also where we are today with regards to those markets, and show people better than any interview can the incredible upside that awaits investors who have the ability, within reason, to bottom tick a bear market. These are truly epic opportunities.
Okay, let's talk about the gold market today. And in a world with over $16 trillion worth of negative yielding bonds and with equity markets globally looking increasingly more volatile, is a shift for gold and a new mainstream awareness for gold's role within the financial system perhaps now taking place? Have you begun to see more institutions and money managers beginning to take gold more seriously as an asset class?
We are. Sprott as a firm, as you know, is fairly synonymous with precious metals, given in particular our exchange-traded physical precious metals trusts on the New York Stock Exchange. We, for 7 years, fought a rearguard action to try and keep assets from leaving the firm. Assets are now coming into the firm at a relatively rapid rate. But beyond that, we see increasing inbound interest from the smallest of retail investors all the way through the largest investors in the world, including sovereign wealth funds. I believe that this interest is early on because many of these institutions have a 30-year experience with the fact that bonds were the correct place to store wealth. But as you point out, the arithmetic around, in particular, a sovereign bond is singularly unattractive now. Think about the concept of negative yield. The value proposition that's offered up is that somebody can loan some wonderful payor like Greece or France money for 10 years. And for the first time in history, those governments will actually keep a solemn promise. They promise to give you back less money than you gave them. Jim Grant describes this as return-free risk. Think for yourself how attractive the prospect of return-free risk is. As a consequence, gold is becoming increasingly attractive to the very class of investors that have spurned it for 30 long years.
Let's move on and talk about the psychology of being a speculator. You've been very successful at this over your career. So does it get easier for you as you get older, Rick? When people age, they tend to have more experience and expertise within the markets. But at the same time, aging could go against you because you become more risk averse generally as you age. So how do you view this?
Well, I need to personalize this and put it in my own context because this might not be similar for the rest of your listeners. The first is that all of the money that I now invest sensibly, I got through speculation. So I have learned firsthand the benefits of intelligent speculation. The second thing is that I personally speculate with money that I can afford to put at risk because I have enough money set aside that my lifestyle and my responsibilities are taken care of. Those are two important considerations. But I also have a psychological profile that's geared to speculation. The idea, as an example in speculation, is that the most common outcome is a loss, is something that I can live with, because what I've learned is in a series of intelligent speculations, the rewards that I enjoy on the smaller number of transactions that are successful offsets the losses that I experience in the relatively larger number of transactions. 1,000% return can offset several 30 or 40% losses, but many people psychologically aren't prepared to accept loss. In other words, the non-financial aspects of the loss in speculation is something that they are ill-prepared to handle. I personally am both financially and psychologically geared by now, after 45 years of experience, to be a speculator. Many people, too, misunderstand the nature of speculation. Speculation is all about probabilities, trying to answer some unanswered question that involves a financial transaction. You attempt in your own mind to solve the equation that has to do with probability versus risk versus return versus duration and the time value of money. That sounds complex, but if you observe it in its parts, it becomes less complex.
And as a side note, how does luck or intuition play into the role of being a speculator for you, Rick?
I think luck is important, but I think that there's two things about luck. One is that in speculation, you certainly can improve the odds. Luck is the only thing, as an example, that might work for you at a slot machine. But speculation is very different. You can speculate on people. You can speculate on commodities. You can speculate on outcomes. You can speculate on a wide variety of things where the harder you work, the luckier you get. But the second thing is that you need to right size your bets so that you can spread your speculations over a larger number of particular outcomes. If you accept, as I do, that more of your speculative decisions will end in failure than success, you understand that putting all of your eggs in one speculative basket is a very poor choice in asset allocation. By contrast, building a speculative portfolio of, say, 10 positions where the probability is that you will enjoy, if that's the right phrase, 20% losses. Let's say that there's a 70% probability that that occurs, and a 30% probability that you'll enjoy 500 or 1,000% gains. If you just do the simple arithmetic across that portfolio of 10 disaggregated outcomes, you will see that a carefully chosen speculative portfolio can perform very, very well if you have the financial and psychological capability of assembling that portfolio.
Very good. Okay, let's move on to the uranium market. And I'd like to get your current thoughts on uranium, Section 232. And do you still believe more Japanese reactors are needed to come back online before a real bull market in uranium can begin?
I absolutely do. And I have to give you a headline quote. I am less bullish on uranium now than I was 12 or 18 months ago. That doesn't mean I'm not bullish. I continue to believe that the uranium price will eventually meet or exceed the cost of production. But let me qualify all that. The last time you had me on discussing uranium was about a year ago, and I said that over time, the pace of new build reactor construction would overcome the demand deficit in uranium, which I still believe to be the case. Last year, global uranium demand exceeded pre-Fukushima levels, even without Japanese restarts. But the near term in uranium will be governed by the pace of Japanese restarts, which has been extremely, extremely tepid. What I had said was, until the blessed event with regards to new build construction kicked in, the Japanese restarts were what were needed to increase uranium demand while at the same time constraining the supply that came from existing Japanese inventories. Two new things enter the equation which uranium speculators must focus on. The first is that we're in a global economic expansion that's gone on for almost 10 years. And while I'm no economist, history teaches me that this global economic expansion is very, very long of tooth. If the expansion that we're in, no matter how tepid, falters, then demand for all forms of power begins to recede, and the need for more nuclear power becomes constrained. You can have the supply shortfalls that I see coming in uranium. And if they are matched by demand shortfalls or a reduction in the increase in demand, the price can be moderated. The second is that the industry is becoming much more efficient at recycling spent fuel waste, the so-called SWUs, or special work units. What that means is that there is an increasing amount of supply that's coming into the equation as a consequence of recycling spent fuel. If these trends continue, then the estimate that the International Energy Agency has about the cost of uranium, which is based on the cost of mining uranium, and let me digress, the International Energy Agency says that the total cost associated with mining a pound of uranium, including cost of capital and prior year write-downs, is about $60 a pound. If that supply is increasingly augmented by special work unit or recycled spent fuel supplies, and the cost of that fuel is cheaper, then the estimates as to the cost of available supply on a global basis begins to decline. We're working very hard on developing a more fulsome sense of the total cost of supply over the next 18 to 24 months. And I look forward to sharing that with Palisade and Palisade's listeners when it's available to us.
It is well known, Rick, that Graham and Dodd have been two authors that have helped shape your thinking and investment approach when searching for undervalued assets. So have there been any other key books that have helped you? And are there any authors living today that impress you with their work?
Your listeners will hate me for this next recommendation. The most impactful book that I've ever read in my life was Human Action by Ludwig von Mises. It was written in fairly turgid German and translated into very turgid English. But it is, to me, the most important book on investor psychology and the economy ever written. It is also a wonderful cure for insomnia. It's an extremely dense book. But I need to say that the lessons that I've learned from that book have been absolutely critical in shaping my investment success. Things like recency bias, things like the importance of easily observable information, like price being a justification for narrative, are all ideas that I got first from Human Action. The whole concept of individual volition and the impact of individual volition on group psychology is covered in detail, sometimes painful detail, in Human Action. So I think that people who are serious about becoming competitive investors and speculators, and serious about understanding how human action, how volition shapes investment markets and the broader economies, unfortunately need to read this book.
Okay, as we begin to wrap up, Rick, is there anything else you would like to share with our listeners today? Anything else on your mind that we haven't covered?
Yes, as a matter of fact, I have recently offered a service to individual speculators where I will rank their natural resource portfolios. All they need do is email me their portfolio, both names and symbols in text, no attachments, please, to rrule, RRULE at sprottglobal.com. I will rank and return those portfolios. Understand that this is not investment advice. I am simply ranking portfolios. But I've learned that many speculators need to learn the lessons that I learned early in my career. And seeing an unvarnished ranking of your own portfolio is a wonderful way to begin the learning process. It doesn't mean I'm right and they're wrong. It's just a wonderful place to begin a discussion. So once again, your listeners who would like to can email me their natural resource portfolios. Please, no general securities portfolios, natural resources only, to our rule. That's R-R-U-L-E at sprottglobal.com.
Fantastic. Okay, thank you very much for your time today, Rick. Always a pleasure having you on the show.
My pleasure. I look forward to continuing our discussion. Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?